Good morning, everybody. It is Wednesday, March 25th, 2020. Welcome to all of you. I hope that your Wednesday is going well and that, the world looks a little more stable, hopefully, where you are. One of the questions that needs to be asked is, uh, will we recover from this quickly? We have big bounces, we have big ups and downs in the equity markets, the stock market down, 38%, and then bouncing up 10% and 11%. It's crazy. The volatility is unprecedented. The wildness of the moves and gyrations. And we really need to start looking ahead and wondering, the big question to be answered is there something fundamentally deeper that's going to be at work here? What will a path to recovery look like if it comes? I believe, one of the greatest indicators that can give you some idea about the scope of what's to come is the behavior of the stock market when it undergoes its crash sequence. Now, I tell you, at this point in time, it's still unclear to me and many others whether we have another leg down in this initial crash phase or not. The telling point is in 1929, it took about 36, 37 days of decline to put us into a technically defined bear market. Okay, in this particular decline, 37 days in 1929, it took 17 days to get to a bear market, the fastest decline to a bear market in history. Now, that should tell you something there of the magnitude of what was seen ahead that caused such utter and complete panic. Now, we know about COVID. We know about the situation with that, what's going on around the world, and medical authorities are working on that. But the big reality here is sorting out if there was something underneath of it. How do you guarantee everybody? What are the implications going to be? Yesterday it was announced that 1 million Canadians initially filed for unemployment, an unprecedented number in such a short period of time. We're going to have huge numbers here of people filing for unemployment. And it's going to accelerate through the summer. Yes, there will be short-term measures, 3 or 4 months of equivalent, maybe salaries or wages for people, because the expectation is that by that time, hopefully the medical problems, current situation calms down with regards to rates of infection and things like that. But who knows? The real key will be from a technical perspective, and I've always talked about how I'm a believer in the Elliot wave theory, because it's the only theory of trading, and it's the only technical one that's built on charts and not news. It's the only technical trading tool that really maps human behavior, human psychology, panic, greed, and all points in between. And I found it to be extremely reliable. Right now, we have had three big waves down, and typically a Elliott move that's pointing to the direction, whether up and down, will have 5 waves to it. So we'll either go on now and trace out a 4th wave, which is a correction to the downtrend and a little bit of relief, and then have that 5th wave down. Or there is a chance that this may have marked the end of what was a big, scary correction, and all will be well in the future. Some of the guideposts that we need to watch are behaviors of other markets. Now, the United States Federal Reserve has been bound and determined to put a safety net, well, maybe not a Freudian slips, nuts, to put a safety net under every seeming industry, every person, every bank, every equity, every bond, and buying in $100 billion a day, actually $100 billion, over $100 billion a day of debt that's illiquid, and providing liquidity to the markets in an unprecedented way. Well, we've seen a huge rally and comeback in gold and silver after they shook out all the weak holders and loaded up on that. That had been gone through the roof as I record this. So there's an indicator that it's not really gold going through the roof. It's the dollar's purchasing power going down. It means you have to pay more for a ounce of gold, and silver is, of course, coming along for the ride. And silver will ignite because I don't want to call it the little guy's gold, but it's something that the average person can go out and purchase in a small quantity, as opposed to trying to negotiate 1/10 of an ounce of gold with all of the markups on that. And you're just not getting a lot of bang for your buck. So that's telling a story. Meanwhile, interest rates are, the Fed has pegged the 10-year notes down there to make sure that they don't go anywhere while they flood the system with all this money. Question is, will it be enough? And will it turn people's psychology? Well, the Elliot wave will be able to tell us soon, I think, and give us a glimpse at what to come. We certainly know one thing. People's behavior changes when they've had events like this. They make decisions to never do X, never do Y, never do Z again. Make sure I do A, make sure I do B, make sure I do C. Patterns of thrifts, of savings, make sure I don't get caught with my drawers down and don't have a month or 2 months or 3 months of emergency money to spend, and re-examining lifestyles. Do I really need the cruise? Do I really need the Kid Rock concerts and parties? Do I really need the fancy dinners at the $800 bottle service at the Taj nightclub in Las Vegas? These are all things that people will be asking themselves and making decisions. There's no doubt the economy is going to be changed a lot in the months and years ahead. It's just a question of what extent it will be. And of course, the bigger issue also is a health issue. If we can't contain the current epidemic that has been seizing the world and flatten the curve, and we know nothing about reinfection rates and things like that, then we could be in a real long-term situation here. We shall see. Anyway, thanks so much for watching today, everyone, and have a great day. Go out, take a walk if you can, and enjoy a little bit of sunshine.